Good morning, welcome to Join the Dots, and today I'm going to join the dots for you on why world stock markets will collapse. Now, collapse is a very strong word, but if I said to you I expect them to fall more than 50%, would you say that's a collapse? I think it is. Normally they say 20% is a correction. So 50% to me is a crash, a collapse, whatever. Don't go any further than that. Don't make lots of noise about it. You don't need to. Let's join the dots and understand why logic says stock markets will fall 50%. Let's do the hard work. Let's join the dots. So when we look around the world, we see that the US and its global markets total 60.1 trillion. Now this will vary obviously because each day the price moves, but 60 trillion of a total global stock market value of 124 trillion. So just under half. China has a very small number, only 6 trillion. Remember, it's a very new market, China. The BRICS in total, 21.6 trillion. So 2/3 of the world's stock market value lies in the US and the BRICS combined. And what have we got going on at the moment? We've got trade wars between US and BRICS. And it's easy to categorise that because we know what the issue is. The underlying issue is China, US, geopolitical war. It's at war in every sense but kinetic. So there's no missiles firing, and that's great. That's the best thing. But trade-wise, politically-wise, ideological-wise, everything, they're at war. Okay? And it's not going to end. It's not going to end peacefully. So it's not like we can avoid what's coming. But what I'm going to say to you now is I'm joining the dots to show you that we've already gone too far for it to stop. In other words, the consequences are now coming. Okay? The actions of the last year, 2 years, maybe even 3 years are enough to tell me when I join the dots that we cannot now avoid a stock market collapse of at least, in my world, 50%. Right. So when I try and find the dots to join, I listen to people. No one knows everything. In this world, people are projected to know everything. No one knows everything. You have to go out and find those who know their part of the jigsaw. They maybe know 2 parts. Another person knows 2 parts. Another person knows 3 parts. And maybe someone knows 1 part. But you have to put the pieces together. You have to join the dots. You cannot listen to one person. That's it. No. It's not possible. This is a huge world, a very complicated world. Okay, so we need to join the dots. We need to find the people. Now, I've given you once or twice, I've given you Eurodollar University, Jeff Schneider, good guy, pure data, except for one fault, which I'm not criticising Jeff. I know he has to run his site and he has to pay for it. But he has within his site an advert generally for gold leasing, which I really, really don't want you to contemplate too heavily. Okay, I really don't. If you make that decision on your own, that's fine, that's your decision. But I wouldn't do it. And I tell you what I'm doing. I'm not trying to sell anything. I'm telling you what I'm doing. But within his site, many times now, I've seen this gold leasing program. I do not believe that if you buy gold, you should then lease it just to earn 4 or 5% a year, please. Because this crash that's coming is too big for you to be leasing your gold out to an unknown party. It doesn't make sense to me. However, coming back to Jeff's general site, Eurodollar University, one word, look it up, please. And look up the one that's out there at the moment, came out yesterday. Because he's got data. Brilliant, okay? And what's it telling me? It's telling me something that I said day one would happen with these tariffs. There will be no price increases. What? Hold on. How do you have all these tariffs and no price increases? Because the public at the end of the consumer chain have no money now. They just have no money. They're not going to pay another price, an extra price. They'll find something else. They will not pay additional prices. So you say, okay, well, if that's the case, Mike, if the consumers aren't paying, and they're not, and the US CPI is up 2.9%, year on year, 3%. There's no movement since the tariffs. The last 5 months, the CPI is steady. There's no movement. It's just going up. It's 0.2, 0.2, 0.2. Okay? So hold on, the government's taking the money for the tariff. Who's giving them the money? Combination of the exporter from China mainly, but around the world, the importer, and the retailer. They're all absorbing some of the cost because they can't add it on. If they add it on, they won't sell anything. Cars at the moment in the US are stacking up on the dealerships because people won't pay the additional price. It's ever so simple. People haven't got the money, okay? So they're not going to pay another 10 or 15% or 20% or 30% or 50% or 300% on drugs. They're not going to pay it. They will find an alternative because they can't pay it. It's that simple. Okay, so what happens to all these companies, all these importers, exporters, distributors, retailers? They're all losing money, aren't they, over what they would have had if we had no tariffs? Because they're having to absorb some of that cost in order to maintain their sales. Okay? They've all got massive fixed costs. If you think of a retailer, if you think of all its outlets, if you think of its staff, they've got massive fixed costs. They don't change. So once they start to lose margin, what do? They have to lose staff. And this is what I mean. I'm joining the dots, okay? They can't pass on the tariffs. Because they can't pass on the tariffs, they have to find ways to cut costs to balance their books. So they lay off staff. FedEx, huge number of staff laid off. Look it up, okay? I think it was something like shutting 70 odd distribution centres and laying off 20,000 staff. It's a huge number. This is what is happening in the economy now. And you're not going to be told. You're just going to be told that tariffs are going to force prices up. No, people won't pay them. There's no politics in this, there's just simple economics. Now, what is it doing to the world? Well, it's driving down the margins and the profits of these companies. So what is their stock value going to be when they start to announce these reduced profits? Lower. And the market is at all-time highs, 28, 29 times earnings on the S&P. Average around 16. So can you see, it's just logic. It's honestly just simple logic. You take the data from Eurodollar University, and there'll be a link below. So have a look at that episode. It's so important. You can rely on me to join the dots, or you can start to try, because it will help you. If you start to understand what is happening, where the ripples are through the economy. Now, on top of that, we see something very fundamental happening. We see banks, Chinese, American, the major banks buying bonds. This is it's a massive sign that the banks are unhappy lending to the market, lending to new companies, lending to the economy. They would prefer to buy bonds to be safer. What does that do? Let's join the dots. If the banks aren't lending, where are companies going to get their finance from? Where are companies going to expand? They can't. Because the banks are now saying, whoa, we've got problems. Let's just buy government bonds. Because even if those bonds lose money, even if rates went up and those bonds lost money, they can hold them to maturity and they don't need to market them. So they can keep them in their balance sheet and show no losses. Okay? So we have got some fundamental things happening because that causes that word that I've mentioned many, many times to you, illiquidity. Illiquidity equals volatility. In other words, price. They call it volatility, which in my old simple world of 1970s, 1980s, volatility meant up and down. Nowadays, no. Volatility is a code word for collapse or fall dramatically or fall. The words have been twisted. Volatility doesn't mean it's volatile, it can go up and down, it means it's going down. So we're going to see a lot of volatility because the banks aren't lending, companies cannot make as much money, consumers have no more money, consumers are worried about their jobs, like FedEx, 20,000 staff going, consumers are worried about their jobs, so they're cutting back, happening in China, happening in the US. I'm going to concentrate on those two companies today because that's more than half the world's stock market value, it's more than half the world's GDP. Okay, so there we are. Now, I'm going to leave you with one more link that I want you to have a look at, and I'll put it in the description below, which is Ray Dalio. I have a great affinity with Ray Dalio on many aspects because he's a massive historian of cycles and empires and economies. He's fantastic. And in 2019, when I first picked gold and put it up on my LinkedIn site, I had LinkedIn then, they banned me for vaccine discussion. Ray Dalio, a week after I said buy gold to my clients, came out and wrote a beautiful essay on LinkedIn. Gold was 1254, boom, off it went to 2000. Ray Dalio is powerful, his voice is powerful, what he says is powerful. So do listen to his article there that I'll link in below. Okay, so please, I'm joining the dots. That's where we are. Global stock markets face enormous consequences from the tariffs because the companies are having to absorb all the costs. And at the same time, banks have decided we need to stock up on bonds because we need not to create more losses. Okay, we need to be safe. That creates illiquidity in the market. That does not help companies. That does not help expansion. It doesn't help investment. It doesn't help anything. Those are some dots to look at today. Eurodollar University. I'll also link in China Update because Tony talks about the Chinese side of this. I've talked about the American side mainly. And then Ray Dalio. Please, if you're interested, seriously, and I've said to you before, you have to work to protect your money, not just take a random phone call. You have to work, just like you do at work. But this is much more profitable if you get it right than working 40 hours a week, 50 weeks a year, whatever. Okay? Thank you very much.